Good morning, everyone, and welcome to the Ankerstar Wealth Morning Show. I'm your host, Allison Ankerstar, and today we'll be talking about your last chance for IRA contributions for 2022, the latest unemployment number, and the importance of tomorrow's inflation report. But before we begin, as a reminder, this is a financial education presentation and should not be construed as personal financial advice. Full disclaimer information is available at ankerstarwealth.com. Good morning, Steve. Taxes are due April 18th for everyone. What can still be done as far as IRAs?
Well, good morning, everybody. And we are in full swing of tax season, which is fun, right? So that's why we've been a little bit behind on getting the videos out. This is a very busy time of year. So with everybody's questions as well as our own taxes as well. But the question Allison asked there is about IRAs. And you remember the rule is you can go all the way up until April 18th of 2023 to make your 2022 contributions. And that can confuse people, right? So why is that? If you're starting at the beginning, like January of 2022, if you know that how much money you're going to make during the year and you aren't going to get a bonus or anything that's going to mess that up, or somebody's going to start working that wasn't, that sort of thing, you can make your contributions throughout the year. You can either do a lump sum or you can do the monthly amount. However, if you subsequently during that year now exceed your income limits, you may have to undo all of that. So a lot of folks wait until the year ends and then you do your taxes to figure out your taxable income and your modified AGI. And that then determines what do you want to do for your IRA. So a lot of folks will wait until 2023 to make their 2022 contributions just because they don't want to have to go through the pain of undoing it. Now, it is a little bit of pain. It's all paperwork, but that's why the law is set up that way. And of course, if you can do it in 2023, there has to be a fence, and that fence is now tax day, right? Because people could be doing their taxes right now and figure out that, well, they should have made their contributions. And even if you have done your taxes, if you're contributing to a Roth IRA, it's not going to affect your taxes anyway. So you can still do that all the way up to the tax date for 2023, which again is April 18th, as Allison said. So remember, there's a couple different types out there. There's traditionals, there's Roths, there's SEP IRAs. I've never dealt with a simple, and Schwab doesn't do the solo 401k. But as far as the traditional Roth and the SEP, if you have those, or if you have questions about those, you need to really make the decision in the next couple of days, because it does take a few days for the paperwork to get into place and move the actual money. So now is the time. As far as tax forms, what do you get for a tax form for an IRA contribution every year? It's a form 5498. It's simply an accounting form to account for the fact that you made the contributions. So it's not something you need to wait for that form to file your taxes. It has nothing to do with that. It's just simply an accounting form for later on if you decide to do an early withdrawal or anything like that. How much you put in each year can be a factor. So overall, you have until next Tuesday basically to jump on this. Jaden is looking through some accounts this morning to see if anybody hasn't made their 2022 contributions that normally does. So we're going to circle back to that conversation for folks this morning.
Next, last Friday, unemployment dropped to 3.5%. Why is this important to the Fed in their rate hike strategy?
Well, so we make sure I have the right article here. Yes. So if you remember the investment advisory board meeting, I said this is the story of two nevers, right? So, and the two nevers I was referring to was we've never had a recession with unemployment this low. And so that's one side saying, okay, well, we aren't going to have a recession because we never have. And then the other never is we've never not had a recession, meaning we've always had a recession, when the yield curve is inverted like it is, and as much as it is. So one of those two things historically is going to break. We either are going to have a recession or not. But two of those leading indicators are conflicting with each other. Excuse me. So Why is this important? Well, employment last Friday actually dropped from 3.6% to 3.5%. So employment is getting better as far as, people are working. So there's jobs out there that are being created. And, the headline here, it's clear we're unable to get employment as high as the Fed would like. Well, when the Fed is trying to raise rates to slow the economy, unemployment's supposed to go up, right? So traditionally that's a bad thing, that you're trying to slow things down, then unemployment goes up. So that's a challenge, right? Because if unemployment's low, that means the economy's strong, and that means the Fed can continue to raise rates. And again, we have a couple of rate hikes this morning, but that's the importance of the unemployment number.
Last, tomorrow is the release of the March inflation number. How will this affect the markets?
So you have unemployment on one hand, and you have inflation in the other. And the worst thing that can happen is inflation is not breaking, right? So I can't forecast this number because we don't know. Traditionally, inflation has been stickier than we thought, so it hasn't dropped as much as we had hoped. So the best case tomorrow is that it drops like a full percentage point in March. I just kind of don't see that happening. But the worst case, so that's the best case, is if it drops significantly. The worst case is if it doesn't drop at all or increases, right? And if that happens, then the market's going to react to the downside, because that's going to forecast that the Fed will continue to raise rates. So between the unemployment number and the inflation numbers that are coming in, that's the data dependent numbers that the Fed is using to make their decisions on whether they need to continue to raise rates or not. Hopefully we're done raising rates, but we might have one or two more this quarter, and then at that point I think we're done. So the end is in sight, if you will. I know it's been painful, and it continues to be a little bit painful, but it will not last forever. And then once we're out the backside of the rate hike cycle, that's generally when the market recovers, whether or not we have a recession, because that way the market can price in okay, this is now a known, and we can move forward and revalue everything from there, and that generally takes the market higher, even if we have a recession.
Thank you, everyone, for your questions. Please submit your questions as a comment through social media or directly to our email at vipservices@ankerstarwealth.com. And don't forget to like and subscribe to get daily updates. That's all we have for today's show. I'm Allison Ankerstar. We'll see you back here tomorrow.